Howdy, Jacob here. Today we're looking at BG staffing. Let's get into the numbers here. All right, so market cap of 106 million. Whew, that is a small company. Enterprise value of 110 million. Good news there. Not a lot of net debt. Let's see, return on invested capital 11, 11, 8, 21, 14, COVID 1.4, then 12, 17. I mean, looks like they're doing a decent job of returning capital back to the business, but again, return on invested capital is important when you're reinvesting back into the business. If they're paying out all their money through dividends, it doesn't mean anything since they're not putting it back in the business to get these 12, 18, 14, 21% returns. All right, so let's see what their payout ratio is. First, 6.19% dividend yield. It's so interesting. A small company like this is shooting dividends. All right, so cash pay for dividends 11 mil, 12 mil, 5 mil, 5 mil, 6 mil, 6 mil. I mean, they just pay out what they got, really. I mean, they don't pay everything out, so it looks like they're doing a little bit of acquisitions for investment. Hmm. So they're paying dividends and making acquisitions. That's their main form of investing into the business or growing the business. Man, small companies like this, I really want to do deeper dives into, but again, if they don't get to an initial buy price, then there's no point in wasting time. Um, but just preliminary numbers. I mean, it looks like a fine business. Something so small like this could easily get disrupted or eaten over by such a larger company. Um, but I mean, besides the 2019-2020 SPAC and growth, like we're gonna have pretty solid numbers here. So I might just put pretty bold numbers into the assumptions. Just because again, this is preliminary estimation. Um, if it gets close to a price that looks reasonable, then we might do some more digging. But for now, let's start making the assumptions. So, I mean, I might say 5% growth here. They have high return invested capital, but it's such a small business. You can't really. It's tough to give moat status based on ROIC without actual proof of moat. So again, maybe they have regional moats where uh, they're like the only staffing company in certain region, and that could help boost these excess returns since they can't go anywhere else. But again, I won't know that until I do further research. But I feel like it shouldn't matter for now. I might just do 5 and 15 for 5% revenue growth, 15 for terminal PE because I mean they clearly will still have growth potential after 7 years, and I mean the return on invested capital is pretty solid. I wouldn't say it's again moat worthy. Here's what I do like, but I still find weird. So the gross margin is increased from 1920 all the way to 34. Their operating margin is also up from threes to 5.5. Let's see where that is come from. So yeah, their sales and general admin has been increasing very consistently, while their cost of goods sold has not increased as much. So that's why their gross profit's going up quite a bit, but they're in percent wise, but their operating margins are not not increasing to the severity of the gross margins. All right, so let's see. I mean, again, let's look at debt again. See if interest is bearing down on them. So They've issued a little bit of debt here. We're looking at 63 million. I mean, I guess we could say they average about 10, average 15. So here's 17, 16, maybe 10 to 15 mils. So that's less than 5 times. All right, so it's not bad. It shouldn't have too much effect on interest rate increases. Shouldn't have too much of effect on margins here. So let's just do average since it's been kind of hectic. 5.5. Let's try to do 4.55. Increased a lot of shares recently. Was that for an acquisition? It's not stock-based compensation. All right. Well, they've been pretty consistent, so I might just do 1% increases there, and then all right. So we're seeing the estimated price with these assumptions greater than the current price. So I will have to make a video to do a deeper dive on BG staffing, see if these assumptions actually do make sense or not, and reevaluate this company more in depth. Um, oh, I didn't look at the dividend. So 60 cents, paying about 6. I mean, I think that's still reasonable. Just say 0% growth on dividends, even though they'll be up and down year by year. That's fine. I'm not going to estimate where they're going to be each year, but should average out pretty well. So, yeah, we'll do a deeper dive here. And again, it's just tough looking at $106 million market cap company that's spewing out a 6.19% yield. So, all right. Well, thank you, everyone. Hope you have a good rest of the day.